While precious metals rally, indicating rising safe haven demand, the commodity directly in the line of geopolitical crossfire has been oil. Despite expectations of a deep global oversupply, crude prices have rallied sharply this year already. Take a look at this next report for more details.
Coming into 2026, most oil analysts expected a deep global surplus to push crude prices lower. In 2025, prices had already fallen nearly 20% as supply outpaced demand. The International Energy Agency estimated the market would be oversupplied by about 3.7 million barrels per day. Yet prices have moved in the opposite direction. Since the start of the year, Brent crude is up roughly 15%, while WTI has gained about 14%. Despite consensus expectations of a 2 to 3 million barrel per day glut this year, crude prices are now higher than they were 6 months ago. Analysts say oversupply and higher prices can coexist, especially when short-term disruptions reshape market expectations. A key driver of the rally has been geopolitical risk. US sanctions on major Russian producers Rosneft and Lukoil have effectively removed around 600,000 barrels per day from the market. At the same time, drone strikes near the Black Sea terminal have disrupted exports across the CPC pipeline. Tensions in the Gulf have also added a risk premium. Nearly 20 million barrels per day move through the Strait of Hormuz, and any threat to that choke point pushes prices higher. Meanwhile, attacks on commercial vessels in the Red Sea have forced tankers to reroute around Africa, raising freight costs and tightening physical delivery markets. Together, these supply-side disruptions have offset part of the projected surplus. Demand has also been stronger than expected. While manufacturing activity in Europe and China has slowed, transportation demand, cold weather conditions and resilience in other regions have supported consumption. The IEA recently raised its 2026 demand forecast and reported that global supply fell by 1.2 million barrels per day month on month. Even so, most forecasters maintain that the market remains structurally oversupplied. Goldman Sachs expects Brent to average $56 per barrel in 2026, more than 20% below current levels. For now, elevated geopolitical risks and stronger than expected demand are keeping prices supported. But unless the surplus narrows meaningfully, analysts say downward pressure could re-emerge later in the year. Business Bureau, WION World is One.